Now you will look at corporations. Again, you will concentrate on the equity section of the balance sheet. Rather than owners' or partners' equity, the equity section of a corporation is known as shareholders' equity. The shareholders' equity section of a corporation is more detailed than that of a sole proprietorship or partnership. It contains two different types of accounts: share capital accounts and retained earnings account. The share capital accounts consist of accounts such as common shares and preferred shares. In these accounts, you record the amount invested in the business by the shareholders. The discussion of common and preferred shares is beyond the scope of this course. However, it is enough to understand that there can be many different types of shares sold to shareholders, and each type or class of shares sold is recorded in a separate account. The retained earnings account is used to record the net income, which is retained in the business at the end of the year. The retained earnings account will be used to close the income summary account at the end of the year, and will also be reduced by the amount of any dividends paid to the shareholders. At this point, take a look at the entries that occur when a corporation issues shares of stock, declares dividends, and finally closes its accounts. When a corporation issues shares of stock, it records two things. First, it must record the cash it has received from the sale of the shares. And second, it must record the value of the shares sold. The debit side of the entry records the cash received. The credit side records the increase in the share capital account. This is calculated as 10 shares times $100 per share equals $1,000. In this example, common shares were issued. Therefore, the credit is to the common shares account. A bookkeeping entry is required when a dividend is declared. This entry is made as soon as the board of directors announces or declares to the shareholders how much they are planning to pay in dividends for the year. Notice that you have two new accounts here: cash dividends declared and dividends payable. Cash dividends declared is an equity account, and it's the account that will be closed to retained earnings at the end of the year. Dividends payable is a liability account. The next journal entry is made to record the actual payment of dividends to the shareholders. The liability account, dividends payable, is reduced to zero by debiting it for $2,000. And the cash paid out is recorded by crediting cash for the same amount. Finally, at the end of the year, you need to close the cash dividends declared account to the retained earnings account. Since cash dividends declared has a debit balance, to close it, you will credit it for $2,000 and then debit retained earnings for the same amount. The final journal entry you will make is the entry needed to close the income summary account. This account is also closed to the retained earnings account. One other key difference between sole proprietorships, partnerships, and corporations is that in a sole proprietorship or a partnership, the owner or partner records his share of the net income of the business on his or her own personal tax return. A corporation, on the other hand, is subject to corporate income tax. The corporation must file a tax return each year and pay the tax owing on its earnings. For this reason, a corporation will also have an income taxes expense account on its income statement and an income taxes payable account on its balance sheet to record the accrual of income tax. In the task, you will practice making bookkeeping entries for corporations.